Tax students, welcome back. I want to do a very brief overview of the Form 1040 in this segment. And some of you are starting some of the tax problems that we need to work on. And for those of you that haven't, the easiest way to get a tax form is to either get it from the IRS website or, whoa, bad typing, whoa! Or just do a Google search. And if you do a Google search, you can see that this web address here is the IRS, and so we can get ourselves a 1040. And this is quite likely a fillable 1040. So if we needed to do a tax return for a practice problem, we could certainly use this. Now, last time we talked, we spent a decent amount of time talking about the masthead portion of the 1040 and a significant amount of time talking about the filing status and the exemptions, and in particular the qualifying child and the qualifying relative, the various things that go into this first part here. But I want to focus in today on just a brief highlight of the remainder of the form. And you may recall from 2 lectures ago we spent some time with the tax formula, which was income broadly conceived less deductions for AGI, which got you to AGI, and then you subtracted the standard or the itemized deductions and the exemptions to get to taxable income, and then you reduce your taxable income by potential credits that you may have. Now that formula is exactly how the Form 1040 is organized, and it's also to some extent a bit of how the Internal Revenue Code is organized. So if you're trying to research a question or want to know something about a particular problem that you're working on, knowing where that problem relates to the formula is kind of important, because it will help you to get to the instructions or to get to the research that you need to do. So just want to start here by looking at income broadly conceived, and I'm focusing in on lines 7 through 22. And we're not going to go into every line here, but just a few highlights. First of all, you should be aware that the code doesn't specifically define income. It's sort of assumed that all inflows are income unless there's something that kind of says otherwise. And so there's a lot of specifics, but if you're not really sure, I guess you guess in the near term that you have an income situation. So line 7, wages and salaries, these are kind of most familiar to us. We tend to do or to get a W-2 if we have wage income, and of course you may have taxes withheld on your wage income. A lot of issues around whether or not a person is self-employed or has wage income. So there's a lot that can go into that particular line, and more that we'll study later. But you would drop wage income in on line 7. You then have taxable interest. You may need to do a Schedule B if your taxable interest is significant, but if you have minor taxable interest, like from a local credit union or a small bank account, then it goes in on line 8A. Line 8B would be where you list your tax-exempt interest, and so examples of tax-exempt interest would be interest you might earn on state indebtedness. So if you have a municipal bond from the state of Oregon, that may be exempt from federal taxation, and so it may be listed on line 8B but may not become part of your total income. Then we have dividends, and we can earn dividends on stock, things like say IBM stock, Microsoft stock, and to the extent that we meet certain qualifications, those dividends may end up being qualified dividends. To the extent that we have qualified dividends, they'll be taxed at a more favorable rate than our ordinary dividends. We may have to include our tax refunds as income. If we deducted state and local income taxes on a Schedule A in the prior year, then refunds may become taxable in the subsequent year. So if we didn't itemize last year, then we may not need line 10, but to the extent that we did, then we may have an income situation. Alimony, if we received it, could be income. We may have to do a Schedule A, or excuse me, a Schedule C if we had a small sole proprietor business of some sort, or even if it was large, I guess. Then we have other gains, IRA distributions if we were withdrawing from our IRA, pension distributions if we were withdrawing from our 401k or 403b, rental income if we had a piece of real estate that we were renting out, and then farm income from a Schedule F if we were growing corn or some other product, hazelnuts in our neck of the woods. Then we may have to do a Schedule F. And then unemployment compensation, which we'll spend some time talking in great detail about all of these different types of income at a future point. And then Social Security benefits, if our income is too high, our Social Security may become taxable. Line 21, which is sort of a catch-all if we have other or unusual sorts of income that don't fit into one of the other categories. And then line 22, which is a summary item. So each one of these things will become a point of discussion at some time in the future. And then lines 23 through 37 are our deductions above the line, or our deductions for AGI. One of the things we like about these deductions is that everybody, well, not everybody, but they are not subject to overcoming the standard deduction like these Schedule A deductions are. So these deductions above the line are a little bit easier to obtain than the deductions below the line. So you have educator expenses here. That's a $250 deduction for K through 12 classroom supplies, primarily teachers, but also administrators and instructional aides. Line 24, business expenses for small categories of small business owners. So what these do is these get these off the Schedule A or off the 2106 and bring them to the front. And so that is certain government officials, and then reservists, and then occasionally performing artists. So kind of rare to see line 24 come into play, but you should just nonetheless be kind of aware of it. Health savings account contributions, kind of the big one here for the above the line deductions are retirement plan contributions and moving expenses. So line 26, moving expense deductions. We'll spend some time talking about this. You can deduct certain moving expenses. There's a 50-mile test in terms of your place of employment and where you live. But if you move for employment purposes, then the cost of that moving may create a deduction for you. Half of the self-employment deduction, and then line 28, 29, self-employed retirement plans, and then self-employed insurance, which are not deductible on the Schedule C's. They're deductible above the line here on the face of the 1040. Penalty for early withdrawal on the savings, and then alimony that you may have paid. A lot of room to discuss alimony versus child support. So alimony received is income, and alimony paid is a deduction. Child support is neither. So certainly a recipient prefers child support, and a payor prefers alimony. And so there's nonetheless definitions in the tax code that define the difference between the two. Line 32 is the IRA contributions. So when you hear people talk about making an IRA contribution to get a tax deduction, there it goes on line 32. There are phase outs for high income taxpayers and other requirements such as earned income that come into play with an IRA deduction, and we'll get into those in greater detail at another point also. Student loan interest, and then tuition and fees deduction. Although line 34 is not often used, because most of the time the American Opportunity Credit or the Lifetime Learning Credit end up being more advantageous, but occasionally line 34 will come into play. And then the domestic production activities deduction, or the DPAD, which would be a deduction that you may take if you're a Schedule C filer and you meet the requirements for that. And so those are deductions for AGI. You can see line 36 is a summation of all of your deductions, and then that line is subtract from your income to get your AGI, or adjusted gross income, which is line 37. Line 37 then carries over and becomes line 38 also as we begin page 2. Line 39A and B is checking for additional standard deductions. Line 40 is where we drop in the standard deduction or the itemized deduction. We'll spend some time looking at the Schedule A and itemized deductions at a point in the future, but I'll just mention at this point that about 21 to 25% of the population can itemize their deductions and have their itemized deductions become more than their standard deduction. That is primarily caused by owning a home and having mortgage interest deduction along with property taxes or real estate taxes. Those items usually get a person onto the Schedule A, and then once there, they may have charitable contributions, possibly medical expense deductions or casualty losses. Now, in any given year, a person may have very large casualty losses or charitable contributions or medical expense deductions, which might get them onto the Schedule A. But you find that, by and large, the people who are kind of consistently on the Schedule A tend to have mortgage interest and property taxes that kind of make their Schedule A end up being more. Then we get some exemptions, line 42, where we multiply our exemptions times the 40,050 in this particular year, which is 2016 tax form that we're looking at. And so the standard deduction and the exemptions create some subtractions from the AGI, which then get us to taxable income. The tax is then calculated either by the software or by looking up in the booklet form or by using the formula method to determine the tax. I'm not going to talk about the AMT at this point. Then there's also a reconciliation with the Affordable Care Act credits that you may be taking. And then there are some credits listed here. So there's credit for the child independent care, educational credits, retirement savings contribution credit, and the child tax credit, along with residential energy credits. And remember that credits are a dollar for dollar reduction in your tax that you owe. Credits are more advantageous than deductions, and so they are listed there. And then line 57 drops us into some other taxes that we may owe. Additional taxes on IRAs, self-employment taxes, household employment taxes, just various additional taxes that we have to consider. And then line 64 looks at our payments and or some refundable credits. The most common refundable credit is the earned income credit, but there are a few others, like a portion of the American Opportunity Credit. And then finally, near the bottom of the form, we get into the refund or the amount that we owe, and then some signatures. So just really briefly, although I talked more about lines than I wanted to, filing status, then exemptions, income broadly conceived, which is consistent with our formula, deductions above the line, which get us to AGI, deductions below the line, the itemized deductions or the standard deductions, and the exemptions, which get us to taxable income, the calculation of the tax, other taxes that may come into play, payments, and then credits, which reduce the tax that we owe. And then we look at the amount that's already been remitted to calculate the amount that we continue to owe or the refund that we may receive. So you can see that this Form 1040 is organized very much like the tax formula for an individual. And the structure of the 1040, along with that individual formula is quite helpful to us. And if we understand that structure, then as we look at issues like, is this deductible, then we can look for deductions above the line or deductions on the Schedule A. So knowing the nature of the question that we have, or is this included in income, gets us to the portion of the formula or the portion of the 1040, which helps us first get to instructions that we may need to read, or a chapter in publication 17 that we may need to read, which may then lead us into further research that we may need to do. So that's just a very brief overview of the Form 1040. And again, any form or schedule that you may need, if you know the form or schedule, you can simply go to Google and ask for that form, and it'll probably immediately link you to the IRS website and the form. You can go to the IRS website and search for a form, but it's actually faster to get there through Google. The Google search engine is quicker, and I guess there's less things in the way. You just get there faster than going through the IRS website directly. Thank you for tuning in, and we'll see you next time.